reason, and Kotak Mahindra Bank too is sitting on the back foot. So a lot of buzzers really in the market at this point of time, and not to forget the auto sales data, which has been largely positive. The numbers were expected to be very muted, so the street has managed to kind of beat those expectations a bit. But let's try and decode of where the market is headed as a whole and which are the sectors you need to bet on at this point of time. We have with us Mr. Jitendra Gohil. He's the director at Global Investment Management at Credit Suisse Wealth Management as well. Hi, thank you so much for making time and speaking with us. Jitendra, want to begin by asking you about your expectation from the market as a whole going forward. We are sitting very close to that life high level. Do you see that happening soon? And for the entire year as a whole, what should be a realistic return expectation?
Yeah, hi. Thank you for inviting me on your show. See, for 2023, our outlook was that the first half would look pretty volatile, and we were expecting a very sharp recovery in the second half. I must say that the recovery has started slightly ahead than what we had anticipated. Our view is that the macro is going to remain very strong for India, and if the global growth slows down, India is going to benefit disproportionately. And if you have seen globally, the concerns over recession, concerns over slower growth is engulfing the market. But I think for India, we are seeing that the commodity prices have started falling and GDP surprising on the upside. So we think that from a macro perspective, from earnings perspective, we are in a good shape. We think in the second half of the year, we might see more tailwinds coming to market as the Fed might have to stop raising rates. So hopefully from the next meeting onwards. But in the second half, we are also seeing festive season, and ahead of the elections, generally market tends to do well. So I feel that the market will see more upside in the second half. However, the volatility will be there. We are a little bit concerned about what is happening globally. But net, if commodity prices continues to fall, India will see even further upside from here onward in the second half.
The next couple of weeks, important meetings lined up. Of course, the RBI MPC in the coming week and the FOMC, which is lined up on June 13th and 14th. What's your own expectation? You did talk about that there could be a further upside to the rates from here on. Could you decode that for us? Is it just going to be, let's say, a 25 basis point hike coming in from both the RBI as well as the US Fed, and then probably a long pause?
Yeah, I think our house view is that from Fed's perspective, another 25 basis point rate hike is possible probably in the next meeting or the meeting after, because interest rates are more or less at the peak right now, and another 25 basis point rate hike possible from the Fed perspective. However, from INR or India perspective, we feel that more largely the rate hikes are done. Although there could be some risk, but mostly the probability of rate cut is now gaining momentum in India. We think that inflation is going to fall further as it surprises the consensus on the downside from here onward, as the commodity prices have fallen and INR remaining pretty much stable. Government is also taking a lot of steps in case if monsoon surprises and we don't have a normal monsoon this year. The past reforms that the government has made, and plus import substitution and export restrictions on the agri side, probably might curtail the impact of bad weather. Having said that, we also feel that the global growth slowdown is going to hurt commodities, and that may also lead to some inflationary pressure easing for the government as well. So I think in the next few months or so, RBI is going to pause, but there is definitely some headroom in case if the tax collection starts to surprise on the downside, which is our key fear, by the way. We think that as the inflationary numbers starts to surprise on the downside, the nominal GDP growth for India probably may not be as expected, and hence the tax collection may starts to surprise on the downside, which might push RBI to cut rates in the second half. But things are pretty much okay as of now, and we might tweak our view as we go forward. But net, I think RBI should, is very vigilant in terms of the growth. So we have to continuously watch out for the tax collection numbers. If it starts to surprise on the downside, RBI will have to intervene.
Point taken, need to be watchful of the tax collections, and that could probably steer the direction of RBI action in the second half of the year. But Jitendra, from the portfolio allocation point of view, what's the suggestion at this point of time in terms of, let's say, a move towards treasuries or fixed deposits, long term, short term? What's the recommendation with respect to the portfolio breakup at this point of time?
From asset allocation perspective, we think that debt market has seen a very good rally already in the 10-year. It is somewhere around 7.96 or so. Our view was that the yields will fall, and that view is playing out. We think that from a long-term perspective, equity as an asset class looks attractive from here onward as well. We feel that the investors should look at their strategic as well as tactical asset allocation and stick to those plans. But from return perspective, we feel that India is going to see a very strong growth over the next 5-7 years, and hence equity as an asset class will definitely outperform the bond market, I mean, which we have seen already in the past couple of decades as well. And we think that earnings have come out from slumber. In the past 1 decade, we have seen earnings weren't moving much, but going forward, we think that all the baggages in terms of bad loans, NPAs that are behind us, and government is also very disciplined in their spending approach. Our political risk premium has fallen. India's corporate balance sheets have improved. The macro parameters have improved, and I think that's the reason why we are a little bit more constructive in terms of equity market.
Jitendra, so within equity market, could you quickly help us highlight the top sector that you would want to recommend at this point of time?
So certainly in the near term, we feel that NBFCs and interest rate sensitive sectors should do well. We have written our report a couple of months ago that NBFCs, real estate, some of the consumer discretionary companies should be looked at. We are positive on domestic cyclical names which are exposed to interest rates. And hence, I think NBFCs, real estate are our top sectors to bet on. We are a little bit concerned about what is happening in China, and we have been very vocal about it, that the growth in China could surprise on the downside. And that's why we have been negative on metal space. And also in terms of IT, we think that there could be sideways movement compared to some upside in these sectors that we mentioned. So IT and metals are our underperform or underweight sector as of now, although we don't expect a major downside in IT, but definitely there is more upside in NBFCs and real estate in the near term. Secondly, there are also green shoots visible in the consumption side. As we move towards the festive season, sometimes September onwards, we have to accumulate this stock. Obviously, the cost pressures have impacted these stocks, but that is behind us, and margin improvement is possible. As we go forward, the margin improvement is going to drive the earnings for the consumption space. So we remain a little bit positive on consumer discretionary companies, which have been beaten down badly. But net, I think interest rate sensitive sectors should do well in the next few quarters also.
On that note, we let you go. Really appreciate you joining us on the show. So talking about how the rate sensitives are likely to outperform, and it's more positive for equities versus the debt market at this point of time.